Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the day's schedule events for Tuesday, February 2nd. Actually, we've already had the big news for the day overnight. That was the Reserve Bank of Australia meeting, which kept rates on hold as expected. But the RBA dropped the line from December where it said that the prospects for an improvement in economic conditions had firmed a little over recent months, and instead said that it was waiting to see, quote, whether the recent financial turbulence portends weaker global and domestic demand, unquote. That suggests to me that it sees the risks on the downside and explains why the currency weakened afterwards. I continue to think that with growth in China slowing and commodity prices languishing, the Aussie dollar is a sell against most other currencies except perhaps the Canadian dollar. Here in Europe, we've got only two second-tier indicators coming out. We start off the day with German unemployment at 8:55 GMT. Now, the unemployment rate in Germany has been stuck at 6.3% for the last couple of months, and it's expected to stay at that rate. So what's important is the change in unemployment. The number of unemployed people is expected to fall by 8,000. That's not as good as the fall of 14,000 in the previous month, but it's still in the right direction. Now, it'll be interesting to see what happens if and when more of the 1 million refugees who've turned up in Germany over the past year start to get employed. In any event, as this graph shows, Germany's unemployment rate is the lowest in Europe and therefore isn't representative of the regional trend as a whole. Now, at 9:30 GMT, we get the UK construction PMI for January. Britain's the only country in Europe where the construction sector is particularly significant. Any outlying number could move sterling. The market expects only a slight decline to 57.5 from 57.8, which would still be very healthy and probably support sterling. That's about it for Europe. Later in the day, or on Wednesday at local time, New Zealand announces its employment data for the fourth quarter. Employment dropped in the third quarter for the first time since 2013, so the market will be hoping for a bounce back in the fourth quarter. The market's looking for a rise in employment of 0.8%, but that'll still mean a rise in the unemployment rate to 6.1%. As you can see from this graph, the RBNZ's official cash rate tends to move along with unemployment. So anything weaker will probably raise expectations of a cut in New Zealand rates and weigh on the Kiwi, which is already under considerable pressure. And at 0:30 GMT, Australia announces its trade balance for December. Australia's had a trade deficit since the middle of 2014, and it isn't changing anytime soon. The market's looking for the deficit to narrow to 2.45 billion Aussie from 2.9 billion. Anything past 3 billion could hurt the Australian dollar. Then at 1:45 GMT, the Caixin Market Services PMI for January is coming out. The service PMIs in general aren't as important as the manufacturing PMIs, but services are of particular interest for China because of the questions over China's shift from export and investment-led growth to domestic demand-led growth. Now, December's reading came in significantly lower than expected at 50.2, just marginally above the all-important 50 mark, adding to concerns about the Chinese economy. Any further fall, and particularly a drop below 50, will be considered very bad and will probably be reflected very quickly in the Aussie dollar and New Zealand dollar. Well, this is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.